Today, the company has changed its strategy. It now invests in companies that need tons of capital expenditures, are overregulated, and earn lower returns on equity capital. Why did this happen?
Yeah, well, it's one of the problems of prosperity. The ideal business is one that takes no capital, but yet grows. And there are a few businesses like that, and we own some. But we are not able, we'd love to find one that we could buy for 10 or 20 or $30 billion that was not capital intensive. And we may, but it's harder, and that does hurt us in terms of compounding earnings growth. Because obviously if you have a business that grows and gives you a lot of money every year and doesn't take it, it isn't required in its growth, you get a double-barreled effect from the earnings growth that occurs internally without the use of capital, and then you get the capital it produces to go and buy other businesses. And See's Candy was a good example of that. I've used that. Back when the newspaper business was good, our Buffalo newspaper, for example, was a good example of that. The Buffalo newspaper was making, at one time, $40 million a year and had no capital requirements. So we could take that whole $40 million and go buy something else with it. But increasing capital acts as an anchor on returns in many ways, and one of the ways is that it drives us into, just in terms of availability, it drives us into businesses that are much more capital intensive. You just saw a slide, for example, on Berkshire Hathaway Energy, where we just announced, just in the last couple of weeks, we announced a $3.6 billion investment coming up in wind generation. And we pledged overall to have $30 billion in renewables. Anything that Berkshire Hathaway Energy does, anything that BNSF does, takes lots of money. We get decent returns on capital, but we don't get the extraordinary returns on capital that we've been able to get in some of the businesses we require that are not capital intensive. As I mentioned in the annual report, we have a few businesses that actually earn 100% a year on true invested capital. And clearly that's a different sort of operation than something like Berkshire Hathaway Energy, which may earn 11 or 12% on capital, and that's a very decent return. But it's a different sort of animal than the business that very low capital intensity. Charlie?
Well, when our circumstances changed, we changed our minds.
Slowly and reluctantly.
In the early days, quite a few times we bought a business that was soon producing 100% per annum on what we paid for it and didn't require much reinvestment. If we'd been able to continue doing that, we would have loved to do it. But when we couldn't, we went to Plan B. And Plan B is working pretty well, and in many ways I've gotten so I sort of prefer it. How about you, Warren?
Yeah, that's true. When something's forced on you, you might as well prefer it. But we knew that was going to happen. And the question is, does it lead you from what is a sensational result to a satisfactory result? And we're quite happy with a satisfactory result. The alternative would be to go back to working with very tiny sums of money, and that really hasn't gotten a lot of serious discussion between Charlie and me.